Okay, so welcome to day 3 of the bootcamp, and I'm glad to see that you guys have been coming back, and hopefully you've been doing the homeworks too. Get the memo, the homeworks?
No, I didn't get
No, you didn't get it?
anything
Okay.
yesterday at all. Even the presentation slide was not there.
No, did everybody receive the day 2 update?
I did not.
You should have gotten it. We'll take it offline. As we kind of talked about on day 1 and day 2, we basically have covered 4 themes. We have looked at on the first day we have looked at capital markets and investing and blockchain. On day 2 we have looked at insurtech, and we have looked at big data, AI, and machine learning. And today the focus is going to be on wealth management. Okay. So primarily what we're going to do today is look at a case study on how do you think about automated digital advice, and how do you put together an application leveraging financial data. And before that, we're going to have our first guest talk. I know it's pretty late for Darshak, who is dialing in from India. So I want to kind of give him the stage and let him talk about some of the insights on fintech in India. Darshak, I've known him for close to 6 years now. I've taught at Babson for the past 7 years. And 6 years ago, I taught a class on business intelligence and analytics, and Darshak was an MBA student there. And it's one of my A students, if you will. So he did a really good project in terms of using analytics. And since then, he has been in the industry. He has taken the initiative on a lot of fintech-related projects and digital marketing projects. And he has set up a consulting advisory back in India called Jash Data Sciences. And his primary focus has been working with the local ecosystem. And he has a lot of observations on what's happening on the fintech side of things in India. And I thought it would be good to hear about not just the perspective here, but also about the opportunities and some of the things that are happening in the labor market too. So, Darshak, can you hear me?
Yes.
Okay, so I'm going to give you the stage. Do you want to share your presentation?
Yes, let me do that. Are you all able to see the presentation?
Yes, I think so.
Okay, and are you all able to hear me clearly?
Yes.
Great. So thank you, Shri, for this wonderful opportunity. I think it's come a full 360 degrees for me. I remember sitting in your classes and learning all these amazing things, and literally I was itching to use so many of the things that I learned in your classes. And I'm glad that over the past 7 years, I've had an opportunity to use almost all the techniques, all the algorithms that I learned, and it's been fantastic. So this is about my experience in fintech, primarily in India, but also some discussions and some kind of consulting engagements with a company that's doing some work in African countries as well as a little bit in the South American countries. So let me start with an overview of how the things are different when it comes to fintech in emerging markets compared to markets that are well established in finance and financial infrastructure. So the first thing which not many people in developed economies would imagine is that a large number of people are actually unbanked. So people may not have bank accounts. They're not used to saving money in banks, and so these people are largely probably investing money in things like gold and silver, and actually, uh, saving money that way and having their financial security in a more physical commodity format, like gold, silver. Uh, Also, this affects the people's livelihood in ways that they cannot get access to systematic financial market. So they cannot avail loans at a reasonable rate. They may have to use unofficial or kind of unstructured loans. So those could be, like similar to what you would think of pawn shops or something like that. So yeah, I see somebody has raised their hand.
Darshak, we'll take the questions at the end. So why don't
Okay,
we
sure.
just keep going? Yeah.
Yeah, okay. We'll keep going. So that's the unbanked population, and then there is the underserviced population, which is, like for example in India, now there's a big push for getting people bank accounts, and that's a program that's probably working pretty well. But then now these people have bank accounts, but then they are underserviced. So these are the people who might be living in rural areas where the other financial institutions haven't reached yet. So uh, they still don't have a lot of financial services. And that, again, from my discussion with some of the other people, I've learned that in African countries, it's a quite similar scenario, and probably quite further behind India in some of the cases. And the last one is lack of infrastructure. So this is some things that the banks might require to function, or even financial institutions might require to function, is like high speed internet, uh, reliable power, and so imagine, like, to run an ATM, the amount of infrastructure required is actually quite significant, and it's an expensive investment as well. So even those basic things are not available. But then these things actually create very interesting opportunities. And those are the things that I want to talk about today: how companies are getting innovative, how the startups are actually uh, coming up with very interesting, innovative ideas to service these people, because there is a large opportunity, and there's enough of a profit motive that a lot of startups have really innovated well in these areas. So the first is, use of alternative data sources and informal networks. So we'll discuss more about this in coming slides, which is how people make decisions about somebody's credit worthiness when there is no credit report available. Like there's no Equifax or TransUnion kind of report available. Uh, or even if it is available, it's very, very less history, or very thin report, thin file in the normal financial terms. uh, the other opportunity is, there's less regulation. So compared to the developed economies, there is less regulation in terms of how you can use data to do kind of credit underwriting, or how you can use some personal data to make finance related decisions. So maybe with time, this might go away. Like there will probably be more regulations introduced, but right now there's comparatively less regulation. And then there's less baggage of actually aging and costly infrastructure. So some of the infrastructure is actually similar to how the copper wired phone lines are expensive to keep up with, and the companies that don't have, the countries that don't have those and have a much more wider uh, penetration of mobile services and mobile networks don't have to worry too much about the upkeep of older technology. And so, some of you might find it surprising that probably, like, mobile data packs, and the amount of normal mobile data availability to people in India is actually much higher than uh, probably like what average Americans would be used to. So because for many people that's their primary source of internet, and companies have really slashed the rates to a level where people are able to get a lot of mobile internet at very reasonable cost. Uh, so now this is, these are the areas of opportunities, especially from the point of view of what financial services can be provided with these new ideas and new data points that are available. So the first one, which is social based lending. So this is basically social data based lending companies, and I have worked with one such company called as EarlySalary, which was actually the first one in India to launch this concept of social based lending, and they are doing really fantastic. I think they've raised like Series A or Series B funding, and they are now growing really fast. And what they do is they provide personal loans to people, to salaried people in India, which is kind of similar to the uh, payday loans in US, but the interest rate is comparable to a credit card's interest rate. So you're not charging people, crazy interest or other fees. It's a very reasonable kind of a loan, and then they are also not just 1 month loans, but they are like short term, 3 months, 6 months kind of loans for sorry, yeah, 3 months, 6 months kind of loans. Uh, so we'll talk more about the kind of data they use on the next slides. Uh, then the next one is actually crypto-based solutions or even blockchain-based solutions. So I was in discussion with this company called as Bitminutes, and uh, they have a very interesting concept. They are operational in lots of countries in Africa, and as well as a few countries in South America. And what they do is, in these countries, they had an informal monetary network which was based on prepaid mobile minutes. So the banking infrastructure is not available, and people need to be able to easily exchange money, and probably carrying cash is not convenient, or sometimes it's not even safe. So what people started doing is they traded with each other in prepaid mobile minutes. So if you have 100 minutes, you want to exchange something with someone, you kind of say, okay, this will cost you this many prepaid minutes. And that was so the this company Bitminutes, they saw an opportunity there, and they created a cryptocurrency backed by prepaid mobile minutes. And so now you can actually use their platform to basically transfer money between people very easily, uh, and that cryptocurrency is backed by mobile minutes. Uh, and you can also transfer, you can also exchange the cryptocurrency for mobile minutes very easily. So that's how they are doing. And then uh, the another thing they're introducing, like, why would so you would say, like, what's the use of a cryptocurrency if the mobile minutes are already working fine? But they are providing additional services like micro loans in the cryptocurrency, based on people's transactional data and based on how people have used their platform for historically. So that way they know uh, like whom they can give out loans, and so they are using to provide additional services based on this. Uh, the next is quite interesting, payment solution. And this is UPI. It is actually uh, it's in India. It's called as Universal Payment I forgot the full form of I, but it's basically it's a unified payment something, and it's a payment solution which allows people to transfer money to each other's bank accounts with this national level infrastructure that has made it incredibly easy for people to transfer money between bank accounts without incurring any cost at all. So whatever the cost is absorbed by the banks right now, and then there are a lot of payment solutions because of that have come up. So imagine like if you do a wire transfer to someone, or even like when I was in US, like I found it incredibly difficult to transfer money across different banks. So like the best thing was to actually write somebody a check and they could deposit the check, but there was no real online bank to bank immediate fund transfer. I think now there is some service available. I forgot the name, but at least back then there was nothing like that. And even at that time, India had a much better online fund transfer system, which was like immediate. So if I transfer you money right away, it'll show up in your bank account right now. uh, the other interesting thing with this UPI is that so maybe some of you might have heard about this. So a couple of years ago, the government of India, they pulled out the 500 and 1000 rupee currency notes from circulation. So they said, okay, from now, like they announced that from today these notes are invalid. So you have about a 1 month time to go and deposit whatever notes you have in your bank, and obviously the banks will accept it. You'll get that much amount of credit in your account, but you can't use it for transaction. Like nobody else would accept those notes. uh, so at that time there was a little bit of crunch in the of availability of cash, because the new notes were not yet rolled out. People didn't have cash. So that's when a lot of these payment solutions actually worked really great. So like even the small vendors started accepting these payment solutions very easily, uh, and that actually helped increase the adoption of people using bank accounts, people using other things easily. Then robo-advisory is that's quite normal, like any other robo-advisory. I'll not go much into that.
Yeah, we're gonna cover a bunch of Roboadvisory
Yeah,
today.
sure. And algorithmic trading, again, not much that's different from what you would see in other countries. And the micro insurance, I'll just touch upon that. It's a uh, so what happens is, these are community based insurance solutions that kind of do a community level underwriting. So you would have some leaders elected by people in a community who would monitor how people are actually utilizing the insurance, whether the claims are not fraudulent, whether people are actually, whoever is actually making claims, let's say if it's a health insurance, then whoever is making claims, they are actually like genuine claims, and the insurance companies are facilitating the whole thing, and whatever money they are collecting within the community, it all goes just to that community. So sometimes it's a non-profit kind of uh, system, and that's how it's run, and it helps a lot of small it helps a lot of people, just around the poverty line, who don't probably have means to get private insurance, to actually get it insured and still have the benefits of an insurance. And now this is the most interesting slide that will help you guys understand how companies are getting creative in using data of alternative sources when the credit data is not available. So first is the Facebook profile, where you can get basic data. So like, your age, gender, probably date of birth. And then if you and some other connections of yours are using the same service. So for example, if I install EarlySalary app and some of my friends are also using EarlySalary app, then Facebook also gives you that data. So the connection data is available. The next is LinkedIn profile data. So this is some basic information like your employer and designation. So that helps validating, whether you are actually working at that place. And also, I think education is available. Then tweets is some NLP and sentiment analysis can be done. So like understanding what kind of tweets you send out. And the rest of them are actually quite interesting. So community standing, peer feedback is some data coming from the community. So they would actually ask, references from the community, and the references would provide some information about you and how they would rate you. And then historic transactions and on-time payments and network of connections. So, for example, if I have taken loan like 3 times in last 6 months or last 1 year, and then how many times I've paid it back on time, and then how, like, what is the historic transaction of my connection. So if I have 3 friends who all have taken loans and they all have repaid the loans on time, then that actually boosts my score as well, because that means I'm in a company of good people, and that means I'm likely going to be a genuine customer. And then transactional SMS data. So most banks and credit cards and other things, other services would send out transactional SMSs in India. So companies actually use this data to build your credit profile. Also things like, let's say you are using online gambling or online uh, 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 you're taking part in online games a lot, and you see a lot of transactions, then that could be either positive or a negative depending on how the company sees it. But that kind of data is available. Then data about flight tickets or train tickets, that helps companies see if you are a flight risk to leave the city and go out, if you are in a debt and probably not going to return it. Things like it could be used that way. Then GPS location. So companies generally take like 2 to 3 times a day they would capture your location. So let's say at 3 in the afternoon and 3 at midnight would give them a pretty good idea about where your home is, where your office is, and if you've moved cities, then they would get an idea of that. And then phone contacts, call logs will give you like who are your connections, who are you close to, and also from GPS data they can find out like what other who other people are you in proximity of. So they could also, I mean, that is also used to affect your credit worthiness or affect your even like localizing your service offerings or things like that. So this is social based lending app EarlySalary. I'll just talk about it quickly.
So Darshak, can you
Yeah.
wrap up with the slide?
Yes, absolutely. Yeah. So this is the company that's using social and other data coming from Android phones and uh, other data to provide like credit worthiness of customers. And then so the solution we built was actually able to do underwriting within just a few seconds, which usually took like a week for a manual process, like to apply for a loan and get an underwriting and get a approval. So you were able to make it into a few seconds process. And then we were able to actually automate 85% of all decisions. So like people would apply for a loan, and 85% of the time they are actually either automatically approved or rejected. And then we were able to, like, the model was so good that the default rates of people whom the model has approved uh, was actually lower than the people who human underwriters would underwrite. So that's the case of EarlySalary. Yep.
Cool. Thanks, Darshak.
Yes.
Any questions?
Thank you.
Yes, please.
I'd be interested in, this is quite extensive Mosaic surveillance approach. Somebody mentioned at a session yesterday about different expectations of privacy in different cultures.
Right.
I wonder if we could get a feel for, in India or in other of these developing markets, what the consumer or what the citizen's expectation of privacy is. Is this, are they glad to do this, or is it something that?
Yeah. So just to generalize the question, Darshak, the question is, there are a lot of data sources which you're kind of, reframe the question a little bit.
Right.
A lot of data sources which basically, considering here, it's a lot of private information like SMS transactions.
Correct.
All this stuff. So what's kind of the generic notion of people who are using these services, and what are their perspectives on, privacy, and what is acceptable and what isn't?
Right. So, I would say that this was done about 3 years ago, and at that time, it was much more widely accepted by people who at least wanted loan. That they thought that, okay, it's fair that if I want a loan, they want to know some information about me, so I'm willing to give that. But as more and more traditional kind of financial data is getting more and more available, this people are becoming less okay with sharing this data, because now they actually have option of getting a loan just through their credit report. So if they've built a credit report, they would probably not be using an app like this to get a loan.
Yes,
Thank you.
Yeah, I have a question about the historical default rates for these loans. I'm just wondering, A, how many years history do you have to evaluate default rates? And then secondly, I'm assuming this is a new product, what has been the experience in an economic downturn? Because I guess that's where you would expect stresses to occur.
Yeah. So did you get the question, Darshak?
Yes. So this the default rates we had was only for 1 year, because the company like when we analyzed the data, it was just the company was just that old, and the question is fair. Like, we haven't really tested it across different kinds of situations in terms of economic situations, but what the way we look at it is, we are comparing apples to apples. So we are looking at human underwriting decision in the same period where we are comparing the automatic machine learning based decision. And in that same period, in that same kind of economic situation, the machine learning model actually slightly performs better than human underwriters.
Cool. So if there are any other questions, Darshak, I'll be happy to, his information is available on the slide deck we're going to share. So please reach out to him directly. Thanks so much, Darshak. And you're welcome to hang out if you're not still asleep.
Thank you. Thank you, everybody.
Cool. So we will, I'm just going to try and, okay, so. So we will, okay, so that was Darshak, and included his slides as a part of the presentation. So you'll be able to review some of the materials he shared. Okay, so today we wanted to cover one theme, which is Roboadvisors and wealth management, which I presume everybody has one on their phones. Yes? Betterment, I don't know, you use it? Any, is it better than what you used before?
app or just the advice in general? Yeah, personal capital.
Both, actually.
Yeah, personal capital,
Right.
transparency, and
Absolutely. Yeah. So it's a wide topic. I mean, a couple of years ago, this was very novel, but there's been a lot of research and there's been a lot of publications related to that, and it's extremely difficult to cover it in a very short setting. So I'm going to, give you at least like 50 to 100 pages worth of material, which is publicly available, so that you can read and get a thorough overview of what digital advice, automated digital advice, is all about. And we're going to focus more on, if you wanted to prototype a solution within your organization or as a startup, build the whole thing, what does it mean and how do you actually go about doing it? Before getting there, I want to kind of share some of the insights which were basically collected. And one of the surveys, I don't know how many people have read the survey. So the FINRA and the CFA Institute basically came up with a survey, and the assumption is that they were looking at the propensity of millennials and their behaviors towards investment. And they had 7 different hypotheses, and they wanted to test out whether those hypotheses are true or false, and whether compared to the older generation who are used to traditional banking, what are their perspectives towards the newer instruments. And there's a nice report which basically talks about the various survey questions and the ways in which the various people approach those questions. I found a couple of them interesting. This one on the left says millennial familiarity with Roboadvisors. And that was kind of interesting that 63% of them had either heard of Roboadvisors or had used Roboadvisor services. These were like the target group, which were basically asked about Betterment, Wealthfront, etc. On the other hand, interest in terms of using Roboadvisors was kind of a mixed number. Like 50+% of people were interested or extremely satisfied. You can see it's extremely satisfied. It's a very small number, but the majority of them were interested in Roboadvisory related services. But the report I've given a link to actually talks more about it. So if you're kind of thinking about starting a business or thinking about framing your perspectives, it's a good report to go to. Another report which I found very interesting was the World Economic Forum report. Has anybody looked into the World Economic Forum Fintech report? So it's a very good report, very well put together, very thoughtful. And there's a whole segment on investment advice, and they've looked at various aspects, and they've primarily taken a consulting approach to look at the various challenges, opportunities, uncertainties, etc. And I found this very interesting because they were looking at the various trends, which are, they kind of generalize it, saying the 4 trends of the investment management industry have shaped its future, and incumbents, not innovators, look poised to benefit. It's kind of interesting because one of the major challenges they are predicting is the newer entrants into the investment management are struggle to gain market share in the face of customer stickiness and high customer acquisition costs. But you can see that the Vanguards of the world, the Fidelities of the world, are also offering newer products competing with the startup world out there. So you can see that they're going to use their power to basically, the market power to basically create products and make it available in addition to the traditional investment services they offer. The third one, which I found very interesting, was primarily from a risk perspective. When people talk about robo-advisors, it's very interesting to always look at the various opportunities which are out there. But the ISCO report, they talk about various aspects of fintech, but they also talk primarily about what could potentially go wrong. And they have done some good research on figuring out like what could potentially go wrong, risks and errors in algorithms, risks in overly complex algorithms, risks in overly simplistic algorithms, and risk of static client information. And they also talk about some of the other risks in the context of the business itself. So a good report to look at, just to get an idea of what are the various things you have to consider when you're potentially using or designing robo-advisory based solutions. And the fourth report I found interesting was this digital advice report, which was put together by FINRA. I shared some slides on day one about questionnaires and how different digital advisors were giving different portfolio combinations based on what they thought was the right one. But they also have kind of talked about some of the principles you need to factor in, the fiduciary responsibilities, the potential legal implications about it. So it's a good report to look at. Customer-specific suitability of digital advice, which is basically the whole notion of customer profiling. How do you kind of look at the potential target market, and how do you actually factor in the various aspects, especially when you're in hands-off mode and you're digitize the whole experience, and you have to basically build in the intelligence in your applications to kind of factor in all the potential use cases which you may potentially encounter when you are working in a digital scenario. So that's a good report to look at too. So I've shared the links to all the 4 reports, and please review it because it's more than 150 pages of information. It's hard to kind of condense it into one session, but you have all the published reports. It's publicly available, so you can definitely read through it and get some more insights for it. Okay, so what I wanted to do was, well, I am a big believer in case-based learning. And whenever I kind of teach my classes, I usually give assignments to students to basically think soup to nuts, build something from scratch that we can kind of understand what are the various challenges involved in building out the whole solution, and also get an idea of what are the pieces which are missing, and how do you think about integrating those aspects when you're building out solutions. When we do the Fintech certificate program, we typically have a component what's called a capstone project at the end, and people typically kind of come up with their own project idea, and the goal is to prototype a product from scratch, and they kind of build various components, and they actually have a working solution at the end of the whole exercise. It's usually a 4-week project, and we start out with like a discovery session, and we kind of go through the various stages you have to factor in, and then build out the whole thing. So I've condensed some of those components on how do you build a robo-advisor in the context of what does it take to actually build out a solution which factors in some of the things we're looking at. And I'm going to give you like a plan, and it's left to you if you want to kind of put together a prototype on your own. And I'll be happy to kind of assist you if you have any questions. Okay, so typically, when you are thinking about building out solutions, I've kind of simplified some of these aspects. Obviously, if you're putting together a whole company or concept, you have to think a lot more. But if you are thinking of project setting, what are the things you need to look for? And we'll focus on these 6 aspects. First of all, we'll look at who is this for, and who are we designing this Roboadvisors services for? Because you have various tiers of income level. If you have Merrill Lynch or any of your other financial services, they typically have various tiers, and depending on the assets you hold, they provide you different levels of services. And sometimes financial advisors also give you different services based on how your arrangements with them are. And then we're going to talk about investor goals. How do you actually frame those goals? How do you actually factor that in? And then we'll talk a little bit about where do you get the data, and what are the models and options you have to think about when you're building out solutions like these. The what-if scenarios. How do you kind of factor in different aspects when you're building out solutions? And then some of the analytics and execution-related aspects which you have to think about. I'm going to primarily take a technology-based approach, but I'm happy to talk about some of the financial aspects involved too, because there's 2 camps, right? When we talk about fintech, you have the financial industry, and you have all the data, you have all the know-how, you have the expertise, you have the requisite talent, you have access to the risk managers, you have access to the portfolio managers, you have access to the research analysts, and now you're thinking about how do you put together a solution, the know-how, and automate the solution, right? On the other hand, you have the technology folks who are primarily coming up from a technology perspective, and they're thinking, well, we can have a new channel, and the services which are currently available through traditional means, me setting up an appointment, going to a Merrill Lynch or another house, and then kind of having that appointment, going and sitting there, talking about my options. Well, it works for a cream population. It's not going to work for everybody. You have busy lives, and you may not have that level of assets and we want to kind of do something, but it's not going to be feasible for us to kind of so can we have another channel? So the technologists will be thinking about, what if we design a mobile app, which basically is going to reduce the bar for accessing those level of services. And the other thing, the way to think about it would be, certain things are actually not required to be done in person or over the phone or through traditional customer service. How about we automate those aspects too? Right? So the traditional trading solutions like Charles Schwab or E-Trade or all these solutions basically just help in the execution aspects of it. Right? So you did not really get portfolio advice. I mean, you have additional services, but traditionally you would go to this brokerage saying, it's self-directed, it's my personal account, I'm going to put in X amount of money, I need someone to help me do my executions. And I'm going to go and pay a fee or whatever that arrangement is, and then I'm going to get execution services with these companies, right? And the goal at that point was, I do not want to call my broker and then be on the phone and then say, buy X number of shares for me or sell X number of shares for me, and then be on the phone or wait for that confirmation to come in after a particular point in time. I want that whole thing to be automated. I want the device to be able to do it. So that was the traditional notion of just the execution services. But now the digital advice, if you're thinking about it, would be to say, well, I also need advice on what should I be investing in. So how do you kind of factor that in when you're building an investment solution? So the whole notion is what's called as automated digital advice, right? And so the first question you need to ask when you're designing these kinds of solutions is, who is this for, right? And the CFA survey has looked at various demographics and various groups of people in the basic sample. Potentially, their needs are going to be, in a particular way. So you'll have to factor in demographics. Right? So primarily for millennials, the Gen X, baby boomers. In some ways, like designing a solution is like designing dating apps, if you will. There are kind of different apps for different kinds of demographics, so you have to factor that in for investment services too. But then you have to factor in the asset sides too, because some of them just may have discretionary money at the end of the month, a couple of $100. I want to think about investing. So at that point, how much power do you put in terms of designing personalized recommendations, or do you just go for low-cost products and give them portfolio options on ETFs and other mutual funds? So you have to factor in what the asset composition is and how much level of service and the various aspects you have to think about. And then the skill aspects are the user groups, typically novices, they typically don't know anything about investments, which means that you have to go through this education process, educating them about the various products and what the risks are. That way they can factor that in when they're choosing these investments, or they are experienced and we're just kind of providing solutions to them and they basically make the choices of the various products. And then the engagement level, and that's actually a big thing because a digital solution, a digital advice solution, typically I don't go to my E-Trade account or Charles Schwab account till I may go to just check my account composition, but I typically go there to execute a trade, right? But my social apps, I'm more or less on it, check in multiple times. So if you are trying to build in a solution which engages people, it should be like pull, wherein someone comes in and says, okay, I want to look for a particular asset, or I want to rebalance my portfolio, or I want to buy certain things, or I want to sell certain things. Or is it going to be push, wherein you could potentially express your interests, saying that what, at the end of the month, I'm going to have $1,000, recommend certain options for me, and you would want the app or the service to provide you recommendations on what you may want to buy or sell. So those are some of the things you have to factor in, and typically you have to go through a design thinking exercise to think about what are the various options out there. The next thing is you have to go through this exercise of investor goal illustration, which is basically trying to figure out what are the investors' goals, right? Typically, many of the initial rollout of these solutions were very rudimentary, rule-based, and there's been a lot of work now going on to figure out, well, is it even concrete enough to recommend something specific for this particular persona or should more questions and more analysis have to be done? I mentioned this on day one about some of the challenges people have gone through, but there are a lot of solutions out there. And typically, if you're trying to design one, you have to kind of figure out, when you look at like the various breakdowns. And this was the Barron's report, which was published. They basically surveyed multiple Roboadvisors services that are out there. It's publicly available, so you can go to that link and get that. So they're kind of looking at account minimums, access to advisors, financial planning, transparency, features, customer experience, costs, and performance. So these are the various features of which they have ranked these various Roboadvisors. And you can see that this is Vanguard, Betterment, Sigfig, E-Trade, Schwab, Wealthfront, Wise Banyan, I think it's the Personal Capital, Future Advisor, and Acorns. So you can see the ranking of the various services out there. Obviously, Vanguard has a huge lead in various aspects of that. So the first thing you would want to do is try out these products. If you're designing Roboadvisor services, so you want to build out an app, try it out, figure out how have various other companies designed various interfaces, what are they factoring in already. And one of the other things you may also want to do is talk to the professionals. Like, how do they actually do their work? So if someone is basically, you can reach out to CFP, certified financial planners, or chartered financial analysts who are trained to kind of put together an investment policy. Basically, figure out how do you actually solicit your investment goals, and then see if you can automate some of those aspects. So it's a good idea to interview some of those people to figure out or engage them in some way when you're designing your app to understand like what does it take to build out. You could also conduct surveys, so you could potentially ask people various things and see how they respond. Because sometimes it's a design issue. Because when you do user interface design, you can ask the same question in multiple ways. Sometimes you get more information. You just give them a text box, and they may give you something. It's not going to be objective for you to be able to process that to get to the next step in your advice. So if you're designing user interfaces, so what actually works, so you can conduct surveys to actually figure that out. So once you are able to put together your investor goals, you may have to think about building something like this, wherein you may have to design different questionnaires to figure out why am I saving, what is my purpose of saving, and what are you looking for in a financial advisor, what's your age. That way you can predict how many years this person is going to be earning, what their earning capacity is going to be, and then what are their interests, what kind of assets are they looking at in their portfolio. That could also be used from a modeling perspective to understand whether the person is a novice or an expert. Right? If the person is very specific, saying that I want to be able to invest in certain kinds of classes of products, then you know that this person is educated in those. But if they say, well, I don't know, you give me the recommendations, then potentially they are looking for advice. They need more advice and holding rather than they making their specific kinds of decisions. So then the big question is, do they understand what risk is about in terms of investments? Because sometimes it's always in fine print. And typically, even though these are technology products, you have to look at them as advisory services. You have to figure out all the legal aspects about whether you can actually provide these applications in all the geographic areas. They're state-specific, city-specific, or country-specific legal things you have to factor in when you're designing the applications. Because when you make the service available online, then anybody can potentially download and use your application. And then questions like these are tricky. One of the advisors basically had a question like, have you ever lost 20% or more of your investments in 1 year? So it also talks about the risk propensity of a particular person. So you got to factor in those aspects of whether a person is open to taking risk or if a person has very specific constraints. And then also you had to think about how do you design the decisions based on your questions and the questions you're asking. So all those would require some amount of thought before you can actually build out an application. So I mentioned this yesterday in terms of the quants typically focusing on a lot of quantitative finance or traditional finance related aspects. Now, just because we are kind of building out a digital advisor doesn't mean that we can throw all these things away and just have like an interface. You have to factor in and automate some of these, and I'll show you some of the technological things you could potentially use to factor all these aspects in. On the other hand, there's now, because you're automating various things, you have the potential to leverage a lot of machine learning related aspects too. The way you want your users to interact with your advisor. So maybe it could be a voice-based one, wherein a user would say something like, buy certain things, or show me products which has an annual return of 5% and above over the last 5 years, right? So that's a very specific question which you would potentially ask your advisor, and the advisor could potentially run a query on their Bloomberg station, or they may have another research tool they could potentially use and answer that question. But on a digital advisory route, if you wanted to build in a question answering system like that, you had to leverage natural language processing techniques, and after build that out. So how do you actually build those kinds of layered services if you wanted to differentiate your sets? On the other hand, you could also think about recommendations, because once you start building out your portfolio, you have to think about, well, what does it mean to have a particular composition, and are you risk averse? Are you are you able to take much more risk? Are there similar stocks you could, or similar asset classes you could potentially recommend for research, or even for review, right? Because once a person has a particular portfolio, you could create customized research for them based on the products, based on the composition of the assets they hold in their portfolio, and you can put together additional value-added services for them, and also analytics for them. We should talk a little bit about it in a bit. Okay, so once you have figured out like who your end user group is, who are you building this app for, and how do you actually design the goals, and how do you get their goals together? Now the question is, you have to figure out, well, if you're prototyping things, you need the market data, right? You need the actual data. So larger financial institutions probably already have their own databases, and they could potentially tap into those databases and just historical data. And there is also a stream of live data which we have subscribed. It's going to come into these databases, and it's going to tap into these data sources and get it. Right? For startups, or if you're prototyping things from scratch, then it's a little bit of a challenge because it's going to be expensive. Data is expensive. So there are channels like Quandle. You can go and get some sample or historical data for prototyping. For certain markets, you may even be able to get trials from enterprise clients who actually make their data available through platforms like Quandle. But there are a bunch of other services. If you just search online, especially most of these digital advice products are looking at ETFs primarily, right? So you have these databases of ETFs available. So how can you potentially tap into those? That way you get the historical data for computing various metrics and analytics, but also real-time data, so that when a user goes in, they can actually see the composition of their portfolio based on the market data is currently out there. So I'll kind of not delve too much into the data side of things. If you're interested, after the class, walk through the next launch. There are a couple of data vendors out there. You have the FactSets, the Dow Jones, and a bunch of other people that would love to talk to you if you have any specific data needs, and they can give you more information about it. Okay, so the next thing you have to think about is, typically if you're building out, a solution, you have to factor in a bunch of different things. One is you have to be able to have tools to do portfolio simulation. So figuring out how will your portfolio perform in the future, and that would potentially be based on historical data you have already collected and the models you have built. And you have to be able to do portfolio construction. So which is to basically say, I want to kind of factor in the user's requirements, saying that I'm going to do 60% equities, 40% fixed income, and what would that portfolio look like when you construct those portfolios. The third thing is looking at portfolio optimization. They could potentially be tools you could use to figure out, if I wanted to optimize my portfolio and rebalance my portfolio, what is my optimal portfolio based on the new things I'm going to be adding, or the things I'm going to sell. And then obviously performance computation, how is my performance? Is it time-based? Is it return-based? You have to figure out the returns for your portfolio based on particular snapshots, overall based on a particular horizon. You had to be able to provide all those aspects in your calculations. So in order to do that, there are a bunch of different tools you can start out without having to build everything from scratch. I've worked on a bunch of them. I'm just going to talk about it. Doesn't mean that you have to start there. You can always leverage other tools. So one is obviously MATLAB. I used to work at MATLAB before, so I know a lot about some of the tooling which is out there. There are a bunch of toolboxes, and the nice thing I like about prototyping with MATLAB is, the math is already there. You don't have to hire a quant to start building things from scratch. And if especially you're a technology company, you have a lot of technology products out there, it's easy to just kind of take off-the-shelf components and the models which are out there and integrate it with your products behind the scenes. And then also it gives you a lot of prototyping capability to try out various things without having to spend a lot of time to actually construct calculations. Typically, I looked at like some of the open source implementations. If you want to say, I want to do Markowitz optimization, and they usually start out with like structuring the optimization problem. And then basically say, okay, this is the optimization problem. You're minimizing these. You get the equations, and you have to really understand the equations with the whole thing. Sometimes people think, well, isn't it too granular? Can't we just abstract it out and then kind of have a higher level interface? And some of these tools basically do that. You don't have to kind of go behind the scenes and track everything, because there are a lot of theoretical aspects from a financial perspective in terms of sensitivities and whether Markowitz optimization actually works, and how do you factor in turnover constraints, tracking errors, a bunch of other things. So always make sure that you have the required level of expertise in your group, or kind of start with solutions which already have factored in some of these technical aspects in there. But if you're strapped with cash and you are a big proponent of open source, and you want to kind of start everything and do stuff from an open source perspective, there are a bunch of packages available out there. I've just given you a couple of links. So if you wanted to look at, this is a company called Plotly, which enables you to get like high quality graphics. And you basically pass in the data, and they give you pretty good graphics. And they also have a service called as Dash, which enables you to create like dashboards, and you can kind of embed that in the context of your applications. So what that does for you is you can focus on just basically, instead of you saying that, okay, I need a graph which is colored in yellow, and I need to have these markers in blue, I need to have a box which has the legend, and getting and thinking at that granular level, you could just basically pass the data and then use APIs to get a nice picture or a JPEG or a report, which can be just shown on your end user interface rather than kind of building everything from scratch. So it helps the prototyping aspect, and you can focus on the getting the products out as soon as possible in agile mode rather than getting into the granular aspects of, you need a software engineer who understands how to express all these granular aspects. The question is, the example I give is, let's say I want to design a logo, right? So I can do a couple of things. If I was Microsoft or Apple, then I'll go to a design agency and say, I want to tweak my logo, and I have these colors and these things, and people already know my brand. I just need to change this particular aspect, and I'm ready to spend so much. Give me all these design proposals, and I can spend a lot of time and effort to get there. But if I'm a startup and I'm starting a company, I want to design a logo, I'll probably use a napkin and draw something and see if I can automate it, or just go online and say, I'll pay 15 bucks, 20 bucks, can someone design a logo for me? And you can start at 99 cents. You can get a logo from 99 cents, right? So it depends on where you are. And the same thing when you're building out applications, statistical applications. If you're really cash-strapped, you do not want to spend anything, then you typically look at off-the-shelf components and things which you can cobble up and build out in rapid prototype applications. But if you have, if you're a large company, you probably already have the infrastructure. You've already settled on certain tool chains, and you'll probably start there and kind of build applications out. And that's one of the reasons why, you can look at it from both ways. One is for larger financial institutions, when you talk about incumbents and generalize it from an investor perspective, saying, oh, these are the incumbents, these are the disruptors. The disruptors may be coming up with, oh, there are so many tools out there. You can potentially put all these things together and come up with very innovative solutions, because these were not traditionally thought about in traditional financial companies. But when it comes to like data and access to data, they may not have the right kinds of data sources. They may not have the clean data sources which you require to actually come up with like concrete analysis. On the other hand, traditional financial companies are done a lot with like the databases. They have really quality data, and they may not have all the required jazzy tools to kind of put together really high quality data. So it's a good partnership opportunity to kind of bring in both aspects when you're designing solutions. There's another language called R for people who want to kind of play with R. Bunch of different books, and Jonathan from our studio has written a book on portfolio analysis. You can potentially look into it. Has some good examples. But there's also the R Finance conference, and if you look up all the proceedings, you'll get a lot of insights on which packages to potentially use to build out various models. And you have a package for more or less everything. If you want to kind of do portfolio simulation, portfolio construction, back testing, you can find out open source packages for each one of them, and you can start using some of these aspects to kind of get your project started. Yes, please.
Do you have a preference personally between Python and R?
Depends on the client and depends on the project. We do a lot of work with both Python R and MATLAB. I've seen like if the company is large and they need that level of sophistication wherein the code is tested, and it's more of the reputation risk of something bad happening.
Right.
And they want their people to be able to call someone and say, there's a bug, fix it, kind of a thing. Typically gravitate towards enterprise products. But on the other hand, if it's a company and they basically say, you know what, we'll take the risk. We have that ability to kind of understand what's actually happening. And we are still in that agile development stage where we can kind of build this in and bake it into our products. And we'll get there when we get there, and then we'll talk about some of the challenges which we potentially have. R predominantly came from the social sciences world, and just because there was a lot of researchers who were using R for their research. In the past, like you would basically find the research and the implementation of a particular algorithm or a model come out in R before any other languages. And you would find a package in the open source world readily available, which would do your clustering or machine learning, and you'd start there. But you're seeing now a lot of support for Python also. You see a lot of packages where they're migrating. And then companies like SAS, Networks, they're all kind of always looking at what are the products which are being sought out by people. And if a lot of people are asking for a particular course, they build it into their speed. But they also support it. That way you can kind of, but you'll have to pay a fee to get there. So always there are pros and cons for choosing any of these platforms. But for startups, I usually say go open source first, get the model done right. And then when you get to the scalability problem where I have 10,000 downloads and everybody is wanting to simulate their portfolio, and at that point, I have to think about scalability and how do I design for scalability at that point in time. Rather thinking from scratch. Okay. So I spoke about this, the process pipeline yesterday briefly. So many of the things when we are talking about building out these applications have to be thought about in this perspective too, because you have to. Most of these are like data-driven applications. So you have to factor in, what am I doing in the context of getting or ingesting the data? Where am I getting the data? Is it curated already? That if I subscribe to S&P or FactSet or Thomson Reuters data, so I already know that they have done the curation aspects of it. So I don't have to do any kind of cleansing or building other aspects to it, and then I can just integrate it into my application. But then again, everybody has access to the same data. So you may want to think about, well, if I'm leveraging alternative data, if I'm scraping data from websites, and then bringing in some aspects like what Darshak was talking about. And they were talking about collecting information about transactions or SMS-related data or other aspects which potentially is not publicly available. So they had to build an infrastructure to kind of curate and process all that information. It may not be easily available. But on the other hand, you can think about all these engineering aspects which have to be put in as a pipeline. That way you can try out the thing, and then when you automate it, you basically have a step-by-step process which can be built in to actually build out these applications. Okay, so this is typically the process which you think about when you're prototyping an application. So a couple of things we're going to do. So first, we will, if you are thinking about an application, obviously you may have to forecast your portfolio, how will your portfolio look in the future, and if you have any specific methodologies, typically if you're using machine learning, you'll be using supervised learning methods like regression. There's been a lot of talk about using neural networks and LSTMs in particular for prediction, but also you can go for traditional ARMA or EMA or any of the traditional time series-based approaches for doing forecasting for various portfolios. On the other hand, there's been a lot of interest in unsupervised learning too, so especially in the context of clustering. So if you wanted to bucket various stocks, especially if it's not already labeled into sectors and industries, it's not been very well value versus growth, et cetera, so you can think about using clustering when you're building out your asset pools behind the scenes. But then you can also look at things like market basket analysis, and you can say people who want these assets also potentially want these other assets, and you could build out those portfolios and then kind of use it for building out recommendations, or when you send out newsletters to your clients, you could go out like can we look at like the pairing of these stocks, and do analysis. The recommendation systems is becoming interesting because at that point it becomes like digital advice, and you have to be very cautious about the risks a particular person may potentially have in terms of adopting your advice. So there has to be some thought put into whether these automated advice we are giving based on the recommendations which has been driven by machine learning systems are actually valid, and testing has to be done. So we do a bunch of workshops to kind of have actual examples there. So I'll let you guys look at the website to see if you're interested in any of the other workshops out there. And then the other components you have to think about is scenario and backtesting, because when you're putting together advice, you have to factor in different scenarios and then figure out like the best scenario is typically the one which has to be shared with your end users. So in order to do that, you have to think about distributed computing frameworks, because you may want to test out multiple scenarios, obviously, and then in order to do that, you have to have a distributed framework behind the scenes. So typically, if you're building stuff on the cloud, you have options to build out the whole thing. So typically, it's not a transaction-based systems, right? Your digital advisor is not, you have an interface, you're trying to make decisions, but you also have a lot of backend analytics, which has already been computed for you. And you're basically leveraging those analytics and you're serving back to your end users. So those are some of the things you have to factor in. On the other hand, there are a lot of new frameworks which we talked about yesterday. Please be cognizant that most of these are already available on various cloud vendors. So in order to use this, you don't have to start everything from scratch. You can definitely try out and figure out whether this is something you can potentially use, especially if you're using some of the newer technologies for your predictions of the other operations. And then I think I mentioned this to you yesterday. So the cloud-based vendors already have very scalable power. Now, when it comes to deployment, this is where we have done a bunch of projects wherein we have put things on the cloud, because you have not only static information which you are collecting. So static information are things like your customers already provided on an annual basis what their goals are and what they want to do in that particular year. And then they also provide their demographic information, their annual income, et cetera, et cetera. So you have some static information about that. You also know what their portfolio compositions are. They're specified that they're going to be buying this. Every month I'm going to be buying these assets, or this is my snapshot at a point in time. So all that is static information you already saved in databases. But then you have dynamic information, the market information, which you're constantly getting, right? And based on that information, you may have to do recommendations to your client. Because if, let us say, someone had a portfolio which was heavily oriented towards technology, and then something happened on a particular day, and the technology stocks went down by 30%, right? So suddenly the portfolio structure of your client has changed. The risk has significantly increased. So you have to give clients options to figure out about, I would recommend you to move to cash, or I would recommend you to do something else, or rebalance your portfolio at this point in time, or do nothing. So you have to give certain kinds of advice to your potential clients. So in order to do that, you should be able to process really large streams of information, market information, and then process it. You have static data wherein you are making decisions for individual clients, because individual clients won't really care about the entire market. They care about their particular portfolio at that point in time, either in terms of opportunities or in terms of mitigating risk. But on the other hand, you had to build out the infrastructure behind the scenes where you can process all this large amounts of information you're getting. So there are a bunch of frameworks out there. If you go to Google or Amazon or Azure and look for real-time processing streams, you have a lot of different processes, different pipelines which are out there. I just pulled out a screenshot out there, which basically talks about the various components you could potentially use if you wanted to build out a pipeline to process all this information in real time. Something to think about, because many a times you lose the perspective that you're building an application and rolling it out, but then things are changing, because whenever the market changes, everything will change. You have to build in the infrastructure to factor in the changes. Okay, and then last but not the least, the interface becomes extremely important, because you have to think about your end users, and the primary reason why they're using Roboadvisory products or digital advice products is because they are either mobile friendly and they want to do things over their mobile phone, or they want to have a digital interface which gives them a lot of information. So there's a lot of ways in which you can structure it. I just kind of pulled out a screenshot and I put in like digital advice interfaces. You can see a lot of different interfaces out there. So you have to be cognizant that different users have different analytical needs, but also they need to have the information processed for them in such a way that it's easily accessible. So all your end users are not going to be data scientists who can read all the pie charts and the bar graphs and all the spider graphs you're going to be putting out there, right? So you have to think about like, what does it make sense? How do you actually portray that information? Otherwise, it's just going to look like something which end users are potentially going to use. So what I kind of presented to you is basically the various things you have to factor in when you're doing the requirements analysis towards putting together a Roboadvisory solution. So what happens after you do the whole thing is then you kind of think about your specification, and you have to think about the various technology components you can choose. How are you going to build it? Whether you're going to build it or whether you're going to outsource it to someone else and they build out pieces of the technology. And then how do you actually test it? Because this whole thing has to be done in an iterative way, and you engage your end users so that they provide you feedback as you go. The worst thing you could do is like build out the whole thing and then roll it out and no one uses it, right? Because these are extremely complex products. And the other thing to also look at is how can you leverage partnerships? If you can leverage a data partner who can provide you data early on in a free way, and that's one of the reasons why you have the Fintech Sandbox. In the Fintech Sandbox, you have, I think, more than 50 data vendors who are subscribed to the Fintech Sandbox now. So what that means is if you have an innovative idea, you're creating a new application, so you can pitch that idea and you get access for 6 months of data for free. And that basically enables you to get through that hump of not having real quality data or paid. You have to go, find the data vendors, sign individual contracts with them, and then get the data from them, and then build out your prototypes. And it's an expensive proposition, and many times startups do not have the scale and bandwidth to even go through a legal review. If you're starting from school and a lawyer will charge a couple of $100 an hour, and to review a contract, you're spending $1,000 just to just get the contract review. So the sandbox basically enables you to get through that hurdle. You try it out for like 6 months, and if you find that a particular data set or some of the components are actually going to be required, you can definitely extend that route. and start your innovation process. Okay. But it's not rocket science. It can be formally done, and that's the reason why a lot of larger entities are now thinking, well, we know what we do really well, but we need the innovative thoughts to kind of get there. So in order to do that, we'll set up these labs. So yeah, the Fidelity Labs, the Loft at Manulife, and a bunch of other places. So we're in there basically kind of isolating that particular group from the rest of the enterprise and letting them innovate and come up with interesting concepts. So that's kind of a soup to nuts flow of what does it take to kind of build out an application. Typically, we do like a hands-on exercise, but in this particular setting, as live stream and other aspects, we won't be able to do it. But I'll stop here and take any questions. I know not only for this segment, but we've covered a lot of material the last 2 days. Any questions? Yes, please.
Just taking a step back, looking at fintech from 30,000 feet. Obviously, there's been a tremendous amount of deal activity, capital, companies being formed and so forth. But if you have to assess where we stand in terms of the life cycle of fintech, do you think we're in the second or third inning of a 9-inning ball game, or do you think we're more to the middle, or have we just really started getting started?
I would say we're just getting started, because if you look at how the industry has progressed, the formalization of the banking and the legislations and the operationalization of various products, that has taken over 100 years. Just kind of get to where we were before we have all these newer innovations, newer products. And technology has rapidly changed over the last 20 years. 20 years ago, I did not own a cell phone. I had AOL, basic internet connection. And my world was basically the banks I would see and the products I was exposed to, and that was my world. And today, just because you have so many possibilities, there are so many options available out there, but still it's the Wild West, right? There's a lot of investment going on to support all these innovations, and everybody's kind of hitting the dark in various space, trying to figure out whether is that going to be the killer application. We don't know that yet. There are cryptocurrencies out there, the way in which we are kind of doing interactions. Just because I can do more frequent trades doesn't mean that I have a better solution than what was traditionally available. The intelligence is still not here. Is it just process automation? Is it just because of my personality that I don't feel comfortable scheduling an appointment and going and sitting in front of an advisor and revealing all my things in front of this person and then getting that advice and even trusting this person enough to get that advice versus me just trusting an app to get that advice and doing it? I don't know whether one is better than the other yet. So there are a lot of behavioral related aspects, intelligence-based aspects. So they're just kind of scratching the surface.
So you say it's kind of like the internet in 1997.
I think
where
so.
the
Yeah, more or less.
technology is out there,
Yeah.
people are starting to adopt it, but not even beginning to harness it.
Exactly. And again, you can kind of say the same thing with digital health in other areas too. You trust your doctor versus trust an e-visit, wherein you could potentially plug in your symptoms and your digital advice gives you, maybe you should go and see a doctor, or maybe you should just get this from CVS. Right? So in various ways, financial advice is in a similar way. You trust someone who has, or can basically factor in all these aspects and give you personalized advice. And it's again the quantification of risk. If someone's like putting in a couple of $100 every month, and for that person, a 3% guaranteed rate is fine because they could just keep those couple of $100 in the bank versus this earning 3% instead of 0%. And if they get the guaranteed rate, then it should be fine. Then they don't care about what assets are there in their portfolio, what compositions are there, kind of thing. But someone else who has a multi-million-dollar, portfolio may really need it. I want to look at this person and really, meet my advisor every week, get that personal advise and get engaged in the whole thing. Right? So yeah, we're still starting the service.
You would say the same for banking and insurance as well, that they're
Well,
also-
banking and insurance, they're kind of going through a transformation. We have a traditional structure which is more or less adopted and accepted. But then again, the way the world is moving, you have to kind of look at the demographics, the emerging markets. The needs of the emerging markets are different than the needs of developed markets. And the entities in developed markets are now thinking about expansion and looking at opportunities elsewhere. And now they're looking at, well, there's 1.4 billion people in India, 1 billion plus people in China. They have specific kinds of needs. The way they spend is different. And how do you factor those? Where do you innovate there? Right? So banking and insurance, what we have traditionally thought about or designed for the developed world, is no longer what they need. So you can't just basically take our products and kind of give it to them and say, okay, this is what you're going to be doing. So that's kind of prime for innovation. That's the reason why a lot of fintech-related innovation is happening in a lot of emerging markets, because the needs there are much different. Yeah, please.
So I have a question that's on a different path.
Sure.
So I'm a lawyer,
Sure.
and I'm here to sort of get more familiarity with the world of fintech because some of
Absolutely.
the work that I do
Right.
overlaps with it. So
Right.
at what point do you, as a non-legal professional who's
Sure.
in this field, at what point is your instinct to reach out for regulatory advice?
Right.
in this
So,
process?
obviously, you must be tracking some of the work which is happening at the WEF level or the Fed and FINRA and all these entities kind of thinking about regulation, right? So it's kind of a very interesting way to look at the world because right now the legal structure is designed for the markets of yesterday and today, right? So the newer innovations haven't been factored in when they wrote the legislations at all. But now you have to think about, well, you're basically creating an alternative product, which basically does the same thing as what, if you think about a robo-advisor, same robo-advisory services can potentially be given by a human. And the human is actually bound by a lot of legislations. So should you have to make that legal aspects made available for these technology companies, should they also adhere to the same technologies, right? If you should be open to kind of figuring that out. I mean, that's why I always advise companies that you need to get a legal review of any of the products you have to put together, and also not just from the product perspective, from the end user perspective too. Because if you're putting together a product and it's available for anybody in the world, and you may not meet those legal constraints there.
So where on the timeline do you suggest that?
I would say very early on, especially if you're a startup, even at the design stage, some amount of legal review has to happen, because otherwise, you're designing the whole thing, you've got the investment, and I would actually work closely with the investors rather than asking the startups to reach out to you. Because when we as a startup, typically legal review is always an afterthought, and it's sometimes which is mandatory, required by someone else, and that's where we engage legal advice. But financial professionals, the investors would probably be more incentivized to kind of get that legal review done before they can ask, the companies themselves to put together products and then figure out whether it's, yeah. Okay. Any other questions? So we're running out of time. Okay, cool. So we'll wrap up for the day, and we'll reconvene tomorrow. And tomorrow is going to be the final session, and we are going to be focusing on payments and lending. And we're going to do a lab on building out interest rate predictor based on publicly available lending club data. And I'll give you access to the Q sandbox so you can actually play with the app yourselves, plug in a bunch of things and say, use a neural network model and see what kind of an interest rate you're going to get and play with that application. Okay, so thank you for your attention today, and we'll reconvene tomorrow.
I won't be able to make it tomorrow, unfortunately. Thanks again. Appreciate it.
Sorry. Yes.